not a crook. I've earned everything I've got.
Military-industrial complex.
A new world order.
But we are here to destroy the control over the industry of other people.
I did not trade arms for hostages.
It's been time, theater.
На полный разгром гнусных захватчиков.
Myth20c podcast.
So welcome to the Myth of the 20th Century. I'm joined by Hank Oslo today.
Howdy.
Alex Nicholson.
Hello.
And Hans Lander.
Hello.
And of course, I'm Adam Smith, but you guys knew that. He was very famous for his 1776 thesis about the wealth of nations, and today we're going to be talking about a different form of wealth, digital money. Bitcoin is making the headlines a lot lately with its recent jump in price. We can talk about why that may be. But before we get there, we'd also like to explain how finance got to the point where it's actually not even a bank anymore, and you're completely disintermediated. You have no central authority. And getting there it's been a long road. And so since we're talking about the 20th century predominantly on our show, we'd like to discuss some of the technology advances and digital developments that led up to Bitcoin. So with that sort of overview, guys, what, to your knowledge, was really the first introduction of digital technology to the financial sector?
In the 50s, you had the introduction of credit cards.
Diners Club.
Yeah. And not long after that, you started to see electronic ATMs that replaced a lot of the bank tellers and a lot of the basic transactions you would undertake when you go to a bank in person. And then by the 70s, you had electronic stock trading. And along with that came basic advances in home computing and spreadsheet programs and accounting software. So you started to see a centralization of corporate ledgers and corporate income statements and all sorts of financial statements that really began this trend of disintermediation. There's a centralization in the corporate sphere, especially when you had mainframe computers from IBM running these really early relational databases that were just storing millions of records of financial transactions. And at that point, banks sort of became these highly centralized technological spheres that took over the financial industry slowly in the 80s and 90s.
Yeah, one of the primary consumers for mainframes was insurance companies for calculating actuarial tables, and also banks for handling transaction processing.
Yep. Well, you also had the rise of OLTP, online transaction processing systems. So this really took off in the 90s. I think, Hank, this would be when the client-server model became very popular over TCP/IP, and you had people able to access their bank accounts online. You had people to access their financial management software and brokerage firms online. There's a big intermediation between people and between consumers and the people who are managing their finances for them.
Yeah, it was not that terribly long ago that you would have to literally place a phone call to your broker and ask this particular human being to place an order, and he would actually bundle physically a bunch of these orders and call his actual trader or whatever bank he had an arrangement with to actually handle the trades, and they would actually communicate with other traders in this open outcry, the famous pit. to actually settle that order over, the course of, it could be like a couple of days before everything just kind of settled. Whereas now, like, you go to E-Trade and still you have the same flow of stuff happening, but because it's electronic, you have your trade confirmation in like 5 minutes. You can be spending that cash, 15 minutes after that, as soon as you can get to the ATM.
Did I hear right that the New York Stock Exchange actually has closed all of its open outcry, or has it still got a little bit?
I think it still has a little.
Yeah.
Mm-hmm.
NASDAQ is completely without human trading. It started that way as well. And actually, Bernie Madoff, believe it or not, was a contributor to that system on a good way. He didn't do anything nefarious. But basically, it was just a private collection of institutions trading with each other. And so they just didn't see the point of, at that, like with the technology having developed to the point where it was, they didn't see the point of setting up a physical operation to go with that.
So one way of conceptualizing this for people, Fidelity has an interesting timeline that they produced for the digitization of their operations since 1946 when they were founded. So in 64, they actually purchased their first computer. I'm not sure what model it was, but I'm guessing it was probably an early mainframe computer that was probably used for basic accounting purposes. And by 1974, 10 years later, they had their first 800 number. And then 5 years after that, they had a voice-activated response system. So you could effectively call and get the price and yield quotes 24 hours a day, any day of the week. In 81, they had the money line. So they had nationwide electronic funds transfer to money market funds. So this is sort of the basic, I think this is around the time that the early kind of client server model where you had the ability to send electronic funds from one location to another, although I think that it took a while to verify. It was actually less easy than just to do it over the phone or to do it in person or have it scheduled in person.
One of the interesting things is, like, when you take all these humans and you replace them with APIs, like,
yes,
depending on how open those APIs are, this is like the shock that happened in the 90s that, like, what? Like, people on the internet aren't trustworthy? Like,
well,
if you call your broker and are like, please buy like 1 million shares of Microsoft, he's going to be like, what the fuck are you talking about? Like, you don't have nearly that much money. But depending on what the semantics are of your API, like, maybe that order gets placed in some sense. Like, maybe you end up owning it. Maybe you end up being able to do this sort of check kiting thing where, like, you just have that money as float. They're kind of, depending on your exact semantics, things that previously humans would have filtered out now become possible, even if unintentionally.
Well, a lot of these financial systems were written, I think, and this is when Fortran was big, but Cobalt started to come into effect. I could be wrong. Yeah, I could be wrong on the history of that, but I know that there were a lot of security issues early on, and a lot of banks seem to operate on this assumption that just because you put everything under a computer somewhere didn't mean that someone wouldn't still try and rob your bank digitally. It was sort of a high trust mentality in the early days.
Bank robberies have happened for a long time, and basically everything that we're describing here is just different ways of skinning a cat, reinventing the wheel at high speed. So my question is, like, okay, so people have made certain sorts of operations more efficient through the use of computers and networks, but what does it matter?
Well, it lets you exploit what was previously slack in the system for good or ill. So you can do things like cash flow management that was a lot more tricky back in the day. So you no longer need to have as much just like actual liquid cash available in order to do your day-to-day business, because like orders are coming in electronically and you see them immediately. The same thing with your revenues. I mean, every time a cash register rings up, like you can be updating a database. So, you know exactly where you're going to be by the end of the day. And so, you can like not have those assets tied up, providing liquidity. Instead, you have those assets put to use.
The market is becoming more forward-looking, and this sort of plays out in a very practical way, in the way that Milton Friedman's M2 money rule sort of broke down in the very early 90s.
Yeah, I mean, there's literally no difference between short-term treasuries and like physical ATM Fed bucks, because I can turn one into the other literally, like I said, in 20 minutes or so.
This brings up an interesting point that I can relate to the physical world, in that the more integrated your system is, it's sort of like insurance, right? Like the more people who are getting insurance, the sort of less likelihood that there's going to be all of them at once having a problem. So if you're all sort of on the same system, if there's a fluctuation on one side, there can be a countervailing force on another side. So with like, somebody's short on cash, they can borrow from somebody else who has a surplus. And so the more people who are integrated into the banking system, there should be less volatility. However, there is obviously a couple of problems with this, is that if you have an issue with the system itself, or if there is such a large catastrophe on one of the nodes that it sparks a panic in the rest of the network, then you're actually worse off than you were before. You had a lot of redundancy, a lot of independence. So for example, like 100 years ago, if a bank failed in Cleveland, it didn't spark, a global financial crisis. But in 2006-07, the United States went down, and it took the rest of the planet with it. So I mean, there's kind of like these, network effects that are good, but then it also, if a virus or something, it's kind of another analogy, gets loose onto that network, then everybody's having problems.
I actually disagree with that interpretation of the 2008 crisis, but
of course,
we can come back to that.
Of course. I'm just kind of just making a broader point about like networks and are they good or bad. I was going to compare it also to how supply chains work. So in just-in-time manufacturing, the goal is to have as little inventory on hand as possible, and you reduce inventory costs that way. There's less waste in theory, because you're able to integrate things more quickly, and so then if there's a spike in demand, it ripples out to your suppliers rapidly. But you get your forecasts wrong, or if you don't have everything set up right, you're going to actually have stockouts. So there's risks to making things more efficient is really kind of my main point here.
But it's not just that there's less waste or spoilage. It also massively decreases the barriers to entry. So, like, if you have things these people making various designs of gun parts to comply with different pieces of California legislation, most of these are like 3D printed designs where they came up with something in some free CAD software over the course of a few weeks. They 3D printed a prototype. They ordered some injection molding online from China. And, they just kind of fire off a batch of 100 every time that they need them and just drop ship them to their destination. This has essentially zero overhead at any point in the process. Versus if you actually have to I actually need to buy equipment to manufacture this, or find some contractor by calling people. Most of these things would never actually get to market.
Well, if I understand what your point was, which is a good example of how it works now with a physical supply chain, if there was a problem in China where there was a political system or a political issue between trading with that country, or there was a port stoppage or something like that, then you're out of luck. And
you'd be screwed.
Yeah, that's all I'm saying. We're sort of centralizing things to a node that has a single point of failure. Now, it may not be one node, but it could be a fewer set of nodes than before. And so if there are problems at all of those central nodes, then your whole system has a problem. So that's kind of my main point.
That sounds to me like what we would expect there is, so we're talking about fewer nodes. So before, individual human beings were actually involved in every sort of financial transaction. Like they hand paper to someone else that was filled out with the appropriate details of the transaction. And now we do that electronically.
Right.
So if we thought that this system was fragile, what we would expect is that, people would place a stock order, or they would try to withdraw funds from their bank account, or they'd try to deposit funds or transfer funds, and that would get screwed up. And that's basically the way that a node failure would look today. And I wonder, is that an issue? Do we have that sort of node failure happening much?
Well, that was the whole systemically important financial institution project, right, that the banking authorities embarked on in the United States. They were trying to figure out, are there too big to fail institutions? And if so, what do we do? And how do we avoid moral hazard, and et cetera, et cetera? But they were seeing that as a problem potentially, because when Lehman Brothers went down, that was, you could argue, I guess, but I don't completely understand everything, but it seemed to be that was the consensus of what was kind of the big trigger in the financial crisis when they let Lehman Brothers fail. Most of the other markets were scared, for lack of
contagion was the term of art.
Who's going? I'll just make this point quickly. I would say that the matter of so-called systemically important institutions and the matter of sort of this digitalization of banking, those are two different issues. And that the systemically important institutions, those were just as systemic in 1933 at the bottom of the Great Depression as they were in 2008 when Lehman Brothers blew up, and I think it was in September. And that what we really want to think of when we're thinking about the systemically important institutions is, the elephant in the room, which is the Fed, but we don't necessarily need to take it in that direction yet if that's not where you guys want to take it.
Well, so I would actually push back a little bit on that. Kind of regardless of the sort of distribution of the sizes of institutions and kind of what that graph structure looks like, if you have just a very low latency communication that ends up giving you a lot of returns to scale, you can even see things where okay, barriers to entry are very low. So you have a lot of sizes of institutions out in the tails. Maybe you're even dealing with a lot of them on a day-to-day basis. But the returns to the top dogs end up being so high that by nature of the network effects and the transaction patterns that are enabled, you see them dominating. So you see this, for instance, in things like the Google infrastructure. They collect enough information that they're able to have this feedback loop where the traffic actually improves their underlying product. Or places like Renaissance Technologies, where they seem to be aggregating enough discrete data sets that wouldn't be profitable to trade on their own. But if you combine them, then you end up with enough of an advantage that you can pursue ever more marginal sources of information. So it's not necessarily that it has to have an effect or that they're interlinked, but the technology definitely can have an effect on the sort of superstructure of the market.
Well, you've just named two technology companies, right?
Well, Renaissance Technologies is a hedge
fund. Yeah.
The hedge fund, okay, but it's not a bank, and it's not FDIC insured, and it's not holding deposits or lending money. It's just basically gambling. The difference between the important point, I think, is that we actually have a lender of last resort in the banking system. So it actually kind of doesn't matter if Lehman Brothers makes the dumbest loans imaginable. The Fed, in principle, could just go to, I don't know, let's think of a small bank what's a small bank? I don't want to. Some regional
Bank
bank
of the West.
No bank.
Northeast Tulsa.
Yeah, they could go
Supply.
to, Bank of the West or something, some small outfit, and just foie gras money into them. Okay, Lehman Brothers can fail, but we're foie gras money down the throat of this bank, and the bank actually can fairly easily scale up to double deposits in like 6 months, or double loans on the book in 6 months. The point is that we live in like a world where the banking system is essentially like contrived. We have this construct called the US dollar, and it can be made infinitely, and it can be used to solve any sort of liquidity crisis as needed. My point, here's my point. My point is that the banking system is fundamentally not all that different than it was in the 1930s. It's still a pretty simple sort of arrangement.
So maybe this is a good time for us to talk about one sort of other aspect of banking, which is the democratization of credit. Like the credit card, we mentioned it earlier. I think the first one of any size was the Diners Club in the 1950s. But now, I mean, it's incredibly easy to get access to not insubstantial amounts of
friend
credit.
of mine in school, primary school, his younger brother, so he wasn't even an adult, got one of these junk mail advertisements in the mail to sign up for a credit card. He wasn't even 18, signed up, spent, I don't know how he laundered it into cash, but he spent the money to buy weed, and he got it figured out somehow, just like he wasn't even qualified. Nobody knew who he was. He just was able to automatically start spending. So yeah, talk about democratization of credit. It's pretty crazy.
Yeah. I mean, it's like, people with effectively no income, no job, but no real assets are, granted the ability to spend a certain amount of other people's money, at least, up front. And, you might remember back in the day, like where they had the carbon paper, like a receipt thing. Like, I think this would have been like, early 90s or so when these were still around, before electronic credit card processing. But now, of course, it's like also your mechanism of doing a huge amounts of like online transactions, which don't necessarily involve substantial amounts of kind of ongoing credit. They're just acting as a payment processor, basically, because you pay it off at the end of the month. This seems like this is kind of funky. Like the extent to which you can sort of drive the expansion of the money supply, like the availability of like consumer power, basically, and just kind of goose that in a way that would be completely impossible with cash, seems pretty unprecedented to me. I don't really have it.
Go ahead.
Oh no, I don't really have a direction that I'm going with this, other than like it's novel, and you could explore some of the effects in terms of having credit access to cheap-ish consumer goods seems like a really effective way to placate a population. If you want to look at it through that lens, from another lens, I'm not super confident that the credit card companies actually make a tremendous amount from the credit aspect per se, and like actually charging interest compared to just the transaction fees that they charge merchants. Like banks do just fine in Europe, where they rely almost exclusively on debit cards. So I don't know. What are other people's
I have
thoughts?
two thoughts. One brief, but one of the is that Hans? You want to?
No, that was Alex. But
I'll step in after. Please go ahead, Adam.
Oh yeah, no, just real quick. The only credit card crisis I've ever heard of was in South Korea, of all places, where people went overboard borrowing, and then it created sort of a financial crunch of some sort. I don't think it's ever happened in a Western economy, to my knowledge. There were some issues in Scandinavia. I don't know if it was related to credit cards. But my other point about the credit cards on the digital side of things was the credit scoring. And that has turned into an industry unto itself, where you have a digital fingerprint of your spending, whether you know it or not, based on all of your financial transactions to date that are known by financial institutions. And they share that information with each other. And so you can literally type your name into some website on the internet today, and it'll tell you what your number is. And you've never spoken to anybody about this. You've never taken a test. You've never met, with a guidance counselor. It's just, it knows. And I kind of find that a little bit unsettling, frankly.
You know what? I will counter signal and say that credit scores are fantastic.
Good.
Credit scores are probably one of the best innovations of the past. I don't know when they first started becoming available, but 40 years for financial products. So what a credit score really is.
What does it aggregate? Let me ask you that.
It aggregates conscientiousness. That is it. It is a conscientiousness score. Now, you said that it tracks every financial. Like you said that it models every financial transaction.
No, I'm ignorant. I'm just assuming. I don't know.
Yeah. What it actually does is track, to the extent that you have credit available, are you using that credit, and are you repaying that credit in a timely fashion?
Right.
So this is why it goes up the more old open accounts you have, because that's available credit that you haven't defaulted on.
I assume that's how it works. I mean, I've never borrowed anything except, every month I'll spend something on my credit card and then I'll pay it off. But I've never.
But it correlates fantastically with everything. Because it's a raw conscientiousness score, if you ever solicit a quote for auto insurance, they ask you for your social and your date of birth to run credit, because it's literally the most significant single predictor for whether you're going to have a claim, unless you have DUIs or something.
You pay your bills, basically.
Right. Are you in general a responsible person? This is, it also correlates with every kind of cross-correlate. So you see patterns by zip code, by ethnicity, by gender, by age, all of these things that, could form kind of reasoning about the other way. But to boil it down to a single, conscientiousness quotient is helpful in the same way that a intelligence quotient is handy if you're going to make a very snapshot judgment about a large group of people.
So the banks voluntarily give that information to other companies, or how do those arrangements work?
Yeah, so there's three main credit bureaus, TransUnion, and then two others that I forget, that act as the sort of information clearinghouses, and then they each have their own separate credit scoring algorithms. Experian and Equifax are the other two. Thanks, Alex. But they all have their own credit scores. You might have heard of FICO, your FICO score. Yeah. That's just one of a number of different credit scoring variants. There are a lot of companies that will take your credit report and derive through their own models their own credit score that's optimized for particular usage, for particular kinds of credit, for even non-credit instruments like insurance or leases, or what have you. So that's how it kind of works in a technical sense.
I guess I would ask, when, or did this really start when A, the United States came off the gold standard, and B, when there was the beginning of the financialization, as it's known, of the U.S. economy? So you had an explosion of financial instruments, and you had a huge gain for the financial services industry. in the American economy.
Yeah, I mean, it's difficult to separate cause and effect. Like, there were huge financial sectors under the gold standard in various countries. And, like, you know, consumer credit isn't really that. I mean, it's new in the scale and the availability, but you've had farmers being able to, like, get credits to invest in farm stuff since forever. Like, you know, you had, like, credit shocks leading to farm collapses in, like, the 1880s. So, you know, it's not unprecedented. And you had, like, the removal of the gold standard and, like, this increased financialization at the same time. So I don't think that, like, the increased financialization caused the leaving of the gold standard. Certainly, like, leaving the gold standard and giving the Fed control over the money supply seems like it would let you screw around with your banking sector and with money issuance with the availability of credit easier. But I have no way to quantify that.
Well, I was more interested in. Oh, go ahead, Alex.
Let me just make a quick point about the gold standard. So some people will say that Nixon was the one who had us leave the gold standard, right? But from a practical standpoint, it was actually FDR. I believe it was in 36 that he closed the gold window. Maybe it was 33, somewhere in there. I forget the exact details.
Yeah, I think it was 33. It was like one of the first thing he did was no more gold.
Yeah. And so what that does, I mean, there was still this residual sort of link to gold in that foreign governments could redeem US dollars for bullion. But from a practical standpoint, the US could expand the money supply and it wouldn't, you know, it wasn't bound. Citizens didn't have the right to redeem in gold. And basically, the big thing that this does is it lets the Fed offset shocks to money demand. So if people suddenly, like, whatever reason, people want to hold money more, they're nervous, the Fed can accommodate that demand. So basically what it does is the thinking is that it should smooth out the business cycle by preventing these, like, what we would call a classic recession, like a 1933, a 1929 to 1933 style recession, a demand side recession.
So it's easier to print money than it is to get it back, as I've understood. But how do they encourage? Is it basically just encouraging deposits from the banks to get it back? So if you're talking about smoothing, right, you have to go up and down.
Yeah, exactly. So right now, since 2009, the Fed has massively expanded the monetary base, right, through their QE1, QE2, QE3 programs. That's quantitative easing. Basically, they print a bunch of money and they buy stuff from people, and then they pay banks not to lend the money out. They did that, but every time that they print the money, right, they're not just printing money and then, like, throwing it out into the streets, Joker style from that, like, Michael Keaton Batman movie. They're
love that movie.
Yeah. So they really should have done that, in my opinion, but they have, what they have is assets. So they always have an asset to mop up the extra money with. And what they also have is they have the expectations channel. So they can signal to markets that, hey, the economy is growing, the economy always needs more money, and we'll just back off in the future. And it actually, like, if you think about it, it kind of, like, works by going in reverse, that if people have certain expectations about what the Fed will do in the future, it actually has effects today.
Which is spooky Nick Land shit. Like, the ability of financial markets to propagate the future into the present, to where the present becomes more futuristic all the time, is sort of spooky. I find it a fun dystopian Blade Runner vision, as opposed to a oppressive dystopian Blade Runner vision. But people can disagree about that.
Yeah, I mean, it is what it is. It's just sort of a consequence of these sort of digitalization of finance that we're talking about. And improvements in media is the big thing. Like, back in the Roman Empire, when the Roman emperors in the 3rd century would clip coins and dilute the gold or silver content of coins, it would take like years for those extra coins to work their way through the economy and raise the price level. But today, the financial media and the hedge funds and the banks and everybody is so glued to what the Fed is doing. They actually almost know what the Fed is going to do before the Fed does it. And they discount that into asset prices. So you get this situation where it's almost like, well, we think, to put it in the Roman Empire analogy, we think the emperor, there's a 33% chance that he will clip the coins at, X percent over the next 5 years. So let's modify asset prices to reflect that. And then that's why you get these massive, not massive, but you can get these seemingly bizarre market movements, like huge moves, basically based on changes to the market's perceived probability distribution.
I have a separate question about the Fed. Are any of you familiar with the SWIFT system? I believe they control that.
I'm moderately familiar with it. I kind of became familiar with it yesterday, but
what'd you say, Alex?
Someone else knows more about it.
I've used it a few times to send money to Australia.
How's that work?
Oh, you give them a number and then you give them your bank's address, and
it's just like a routing system. Is that what it is?
Yeah,
all the banks are signed up to it.
Most of the big ones, or normal countries.
Okay.
Yeah, people.
Because if you do a money transfer between institutions, there's a lot of different options. I mean, there's at least 2 or 3, that I've seen, from your brokerage account to your bank, and I guess that's just what it is. It's basically just an agreed upon network of institutions that will agree to exchange between themselves. Is that roughly correct?
Yeah, it's a private sector sort of IEEE type arrangement where people are like, hey, we'd be better off if we did this, so let's participate in this club. It's the same idea behind the big credit rating agencies. Everybody wants access to those data, so everybody shares their data.
I'll ask Hans this, and you can hopefully elucidate a little bit. But I've heard that the SWIFT system is a choke point, for lack of a better phrase, in that a country can be cut off from it, such as let's say the United States wants to sanction someone, and if they don't have access to that system, they have a lot of difficulty conducting financial transactions. So they can't buy whatever commodity they need to buy, and they can't sell, or they can't get paid for what they're selling very easily.
So, I think a couple of years ago, there was a startup that was trying to compete, I think called Symphony. I could be wrong. But you're right. It is difficult to perform any sort of major international financial transactions without the SWIFT system. So basically, what Alex said is right. It's sort of like IEEE. SWIFT is Society for Worldwide Interbank Financial Telecommunications. And same way that IEEE develops electronic standards, floating point standards, computation standards, they've developed a general standard for sending financial transactions and instructions. So everyone is essentially assigned a code, every financial organization, that's 8 or 11 characters. And it's their bank identifier, and then some additional characters that give some insight into where they are. And basically, I guess if you're cut off from SWIFT, it's essentially like the world before SWIFT. So SWIFT was formed in 1974, and before that, you had I think it's Telex. I don't have it in front of me right now, but I think it was Telex, and essentially it was. You had a system that was. It wasn't unified. Machine,
but they never used it. But it was like, oh yeah, we installed that a long time ago, kind of thing. It probably was something like that.
Yeah, like that. So the Telex.
I think that was a GE technology, if I may jump in again, and it was probably geared more towards like inventory stocking up and stuff like that, not necessarily finance. But anyway, sorry, go ahead.
Yeah, I mean, it was a very imperfect system. It wasn't uniform. There were no uniform means of communication within it. There were no uniform codes for every organization. So yeah, if you are cut off from SWIFT, you're essentially shut out of a lot of the major financial transactions going on in the world. There are other services but none of them are nearly as prominent.
And this is controlled by the Federal Reserve of the United States?
I'm not sure on that, actually. Yeah.
It's a co-op.
Yeah.
Well, so is the Fed, right?
Yeah. A cooperative society under Belgian law, owned by its member financial institutions. So
yeah, like the Fed.
I don't know what a good analogy would be. I guess kind of like the regional feds, or like the like Visa, I guess, before it was spun out into its own company.
I guess my confusion is that because I thought, I mean, the Fed is, the stupid quip is it's about as federal as Federal Express, but there obviously is some government involvement in that organization. The president appoints the Federal Reserve chairman, and that could just be that's their charter, and so they grant that power to the president, not the other way around. But what is the scenario where the State Department has a problem with country X, and suddenly they're cut off from SWIFT, the next hour?
Well, I mean, that's like the Iran sanctions
right.
Situation. Like that is the scenario.
Right, but how's the authority legally defined? Because I mean, if they're just membership owned,
I mean, I would guess that like, I would guess that if nothing, if nothing else, you could like certainly just by fiat ban U.S. Based institutions from like dealing with the targeted country or like dealing with anyone who deals with the affected country through SWIFT. You can always regulatorily when you comprise that fraction of the world economy, you can always decide that you're going to like just taint every nth degree until it's effectively impossible to deal with someone.
Is this why Iran had to, or rather Obama had to send those planes full of cash to Iran? Is because they're blocked out from the system?
Quote unquote had to. I mean, the other thing about like payment networks like this is that like cash has its own issues, pros and cons, but when you have a pallet of cash that goes on an airplane and lands in some other country, it's like nobody knows nobody knows where that went. Nobody knows what was in the pallet. It's extremely anonymous.
Yeah, they don't know the origin either. I mean, I've even heard of spooky conspiracy theories that the Russians and some other countries have U.S. Dollar printing plates that they're granted under extreme circumstances to be allowed to use. And so who knows if there's some sort of back channel arrangement with...
I would just assume that they're really good at counterfeiting. Like, and the other thing is that the SWIFT system, there have been over the past couple of years a lot of claims of infiltration of various parties of the SWIFT system. So there were some Malaysian banks and some Middle Eastern banks that were essentially hacked and a few $100 million stolen. There's some fairly credible reports that the NSA is intercepting and modifying traffic on those networks. This was part of the Shadow Brokers release, and you would expect like all these.
So they're running an Office Space scheme, is what you're telling me? They're taking a penny.
I think it's more like they're more interested in the flow. Because of course, like if you're monitoring all the transaction flow, it's not only that like, oh, you can potentially detect who's actually arming whom or whatever. You can get a little bit of foreknowledge. Like if some country is like, I don't know, suddenly beefing up their foreign currency reserves or something. Mm-hmm. Or like some bank, like all the insiders are trying to get their money out of or something. Like there are numerous reasons why you'd want to track as much financial flow as possible.
How do they decrypt it? I mean, just your standard decryption.
Well, for example, the NSA, when they wanted, there was a Belgian telecoms company. This is a few years ago. When they wanted to decrypt the data that they were capturing in real time, they actually, I think, got some people hired in order to steal the encryption keys at this telecommunications company. And so they had recorded they had several recordings that they decrypted, and then they also started decrypting communications in real time in Europe.
Wow.
So it would be very easy to steal the encryption keys, and I'm guessing to do it. I mean, they're probably not skimming money off the top. That's not really there. That's more of a Langley thing to try and get as much money as possible. I'm guessing what they're doing is they're just creating a multivariate analysis. So they essentially create the best example would be OLAP, but they have created an abstract three-dimensional cube of data from all kinds of perspectives. And as Hank was saying, they can track flows of financial data pretty easily if they have access to the SWIFT system. Then they'll compare it against other data that they're gathering from various other sources, and they'll be able to create a pretty strong profile on someone especially with financial data.
That would be incredibly useful for insider trading, actually. I mean, insider trading would be a much better way to raise money than skimming, because skimming could conceivably be known. But if I know that, I don't know, I mean, let's say we knew some company was doing more. I mean, I'm just thinking off the top of my head.
Like you transferred a bunch of money to finance a merger.
Yeah, exactly. And then you could guess who they're going to acquire pretty easily.
Well, I mean, you could front run it
buy
too.
A bunch of options on it, short-dated options, and you get rich.
Yeah, I mean, anybody who works on a trading desk and they're suddenly tasked with a $3 billion order to buy company X over 3 months, they'll be caught if they do it, and it's illegal. But they know that price is probably going to go up, so they can buy a little bit for themselves on the side.
The people that they caught are the ones, or that they catch are always the ones buying short dated out of the money call or put, depending on the direction.
Well, because you can get more money, I guess, because of that. That's when you get greedy. But
I mean, that's literally that's the only people that they ever seem to catch. So I would assume that like there are people who are a little bit more clever than tipping off their brother-in-law or something, and having him do the most obvious trade in the world. Like if you are just marginally subtle about it, like the SEC is not terribly sophisticated from what I've seen at catching these kinds of guys.
Yeah. It's really hard to prove. I mean, it's just
there's an enormous amount of insider trading. It's just my hunch, but like I just have to think it's so obvious that,
and not even like insider trading, but like who runs like the Federal Reserve's like counterintelligence team? Like as far as I can tell, it's really no one. Like how secure are those offices? Like how vulnerable are like the interns to blackmail or bribery or whatever? Like if somebody offers to do them a favor, like 10 years down the line, like, all of this stuff is completely plausible, and they seem like remarkably ill-equipped to handle it for the stakes involved.
There's statistical evidence that the Bureau of Labor Statistics is in some way leaking like the jobs report. The jobs report moves markets every month. And there's evidence. It's pretty clear that they are leaking it, or the reporters who get the release early are leaking it. Someone's leaking it. I just have to think like the Fed is so much more powerful than the BLS in terms of its ability to move markets. I just cannot believe that powerful people are not making some use of that.
I think there was a story a couple of years ago where somebody was suspected of doing that.
Yeah, there's a Federal Reserve president who just resigned, or one of the regional chairs that resigned a few months ago for some, like, I think it was like comment on some story or something like that amounted to disclosure of a move.
That's the big problem with central banking is, the enormous amount of power that you have to move markets. It's not, nefarious hidden things in the shadows. Oh, well, I mean, maybe it is, but it's the real problem is the information. Who controls the information about the future monetary policy moves?
Maybe all this discussion about Fed bucks is a good time to talk about some anarchist money.
So do you guys understand Bitcoin? I have a little bit. I can give a primer on how it works if you guys want to know, if you haven't looked into it.
I think you should do that. I'm not that up on it.
So basically the name Bitcoin refers to the fact that you have a digital right to a digital currency. So that's the bit part. And what it is basically using a public-private key system that you have a private key that only you have access to. And whenever you want to spend what you own on the record of the assets that all the world can see, which is the blockchain, that's like what this big system is built on, you then can send to somebody's public key, and then there's like this algorithm that has to get processed and added to the block, the next block of the blockchain. And then there's all these miners that kind of like verify that it's sort of authentic. This is, very high, hand wavy, but roughly that's how it works. And then that takes a lot of computing power. And so that's how it also is cryptographically safer, because it would be hard to decrypt without all this like verification. And then that rewards the miners for getting, for doing the work. And then that also keeps, because it's controlled by this kind of like very peer-to-peer system, and it's all kind of, there's no central authority. It's sort of, the advantage of this is that it's not prone to the problems we've been discussing with the central system. And it also, we haven't discussed inflation yet, but it's also programmatically agreed upon by all the sort of participants that this is going to be the rate at which new Bitcoin is issued. That's very hard kind of like to compress everything, but that's a rough overview. And then whenever you own Bitcoin, you basically are given it to you by somebody else. So that transaction is sort of how you prove that you own it. So you have a record that goes to your public key, and then only you can unlock that value to send it to somebody else using your private key. But the record is there. It's there for everybody to see on the public blockchain.
Yeah, the key...
Is it like predetermined? My understanding is that it's predetermined, sort of the progression of the number of Bitcoins over time, and that it sort of asymptotes to a fixed number at some future date.
Yeah, but there's like some sort of consensus that has to be formed between like the exchanges or the miners or something. They do control like that rate though, and that basically gets added to like the next version of Bitcoin, and they all have to use it. And so if there's ever any kind of like problem, they all sort of have to agree that this is what we're going to do, because they're all using this like same software to basically mine and make any transactions. So they have an incentive to work together.
Okay, so you could avoid a situation where, say, everybody switches to Bitcoin in 2030, but we've already asymptoted to like a fixed number.
Just the relative value to dollars will go up, for example. Like it's just a monetary quantity base, and so the value of one Bitcoin can fluctuate as much as you want, and you just split it however many times you can desire, because it's digital, it's not physical, so you can constantly
what I'm saying though is they could increase the forecasted path of future Bitcoin production. Like that can go up.
They could, but that's extremely unlikely, because like the protocol exists by consensus. Like the essence of the blockchain, or the essence of Bitcoin, is this ledger, which is a record of literally every transaction that has been performed with Bitcoin.
Yeah, blockchain.
Right. And like the miners are the people who actually process the transactions in exchange for fees, and they also collect these new blocks that are essentially kind of like loot, almost, you can think of. Like, according to the protocol, like a block becomes available on such and such a date, and whoever discovers this secret that hashes to this particular value, that goes through this mathematical calculation and is able to derive this value from, they're the person who gets the block by consensus. So the miners are also the people who own large amounts of Bitcoin. This is where like the kind of self-incenting version, or the self-incenting property of the system comes into play, that the miners want to do things to increase the value of their outputs and of their holdings. So they have a incentive to make sure that Bitcoin is very usable, that it maintains value. It has all these other nice properties that we want from money.
So what happens in? All right, let me back up. I have two questions I want to ask. I want to ask one, when is the number of Bitcoin in existence? We could call it the Bitcoin monetary base. When is that fixed? And then my second follow-up to that is, after that point is reached where we're effectively fixed, we're asymptoting to this fixed value, what is the incentive to mine?
Yeah, I had the same question, actually.
So the asymptote is at 21 million. I don't know when we're going to reach that. Doesn't really matter. The path is fixed, though. It logarithmically rises to that.
I guess
asymptote.
They can just keep slowing it down, basically, so that you'll never reach that
the
point.
halving continues until around 2100 AD. You'll get 21 million Bitcoins in circulation. The miners have incentive based on the transaction fees. So currently they're compensated primarily by actual mining, by like claiming these new Bitcoins that are issued. However, in the future, it's envisioned that they'll primarily get compensated by collecting transaction fees on Bitcoin transactions, which is actually like also baked into the protocol.
That makes sense. Okay.
Yeah. So if you
transaction fees will be way lower than what we're paying now, I assume.
Actually, so that's complicated. One of the technical issues with Bitcoin is that the number of transactions per second for the entire protocol is actually pretty low. I don't have the exact number, but it
takes like 10 seconds. There's like an average number, though. It depends on the mining. But
it would be completely unsustainable to do something like every credit card transaction goes through Bitcoin.
However,
now there are ways that you could solve that problem. Like you would probably have kind of like brokers fulfilling the same role, where they like bundle transactions.
They could underwrite things, basically.
Yeah, there are technical solutions with like how big each like block of transactions is, or like the minimum divisible amount of Bitcoin. There are solutions for most of these.
But I've also heard that sort of lag, that slowness, is built in because they want to discourage.
Because the network
fraud.
has to come to consensus.
Yeah.
Which requires you to do this proof of work operation that like everybody basically checks your math, and like the first person who's able to check your math correctly, which is this computationally intensive process, gets the transaction fee.
I have a question regarding divisibility. So is there a 64-bit floating point limit or anything to the amount of decimal places you can divide?
It's 10 to the -8 of a Bitcoin. One is Satoshi, which could be extended. You'd probably want to use a fixed point format. But one Satoshi, after, of course, the pseudonymous inventor of Bitcoin, Satoshi Nakamoto.
Yes.
So, like, the best part about Bitcoin by far is not any technical aspect of Bitcoin. The best aspect of Bitcoin is the origin story, which is incredibly spooky. So around 2009, this guy on the internet who does not appear to correspond to a physical person, by the name of Satoshi Nakamoto, posts like prototype versions of the software on this cryptography enthusiast mailing list, and it's like basically, hey guys, look at this cool thing I came up with. And he continues writing the code with like minor variations up until like 2011 or so, at which point like he basically goes silent, and a foundation takes it over. The spooky thing is that like there are an extremely limited number of people that have the technical competency and interest to do something like this. And by the way, do it almost perfectly. So you're talking about like network facing code dealing with money, which is always a shit show because you have infinite incentive to try to break it. There's been exactly one bug discovered in the like substantive parts of the Bitcoin software protocol, like over the course of the last 8 years now, which is insane. That's unheard of. Like,
yeah, compared to Ethereum, which is its primary competitor, they've had a lot of issues.
And so people hypothesize like about a half dozen different like credible candidates for like who might be Satoshi, but they all seem ruled out for various reasons. So you're left with like a hypothesis that, okay, so this could be just some savant out there who like just kind of airdrops the like Mona Lisa of cryptographic software and then just goes silent. You could have a situation where this is some research project that kind of goes rogue and caught on that nobody expected. This could be like a whole big spook operation, because the nice thing about Bitcoin from a surveillance perspective is that it is the opposite of anonymous. Yeah. It is pseudonymous, and every single transaction is logged. Right. Like that is Bitcoin, is the log of transactions that happened. So you can invent an address and like send money to it. That's fine. But like you can do so much with network analysis that even if it's pseudonymous, like it is far, far easier to track than cash is.
Well, if you look at how most people, at least on the non-technical side, transact in Bitcoin, they typically start with a company like Coinbase, which requires you to connect to your bank. And so there's very little anonymity at that point if you're worried about a government actor looking at your transactions. Now there are ways around that, but it's not very obvious to people who are not willing to take the technical steps to do it. And so I think there could be a case made for that this is some big, spy dragnet thing that could be created by a government. I don't know.
To give some historical context, Bitcoin was not the first digital currency to make its way online. So this kind of makes it spookier, because these platforms that existed before Bitcoin all kind of crashed and burned. So you had eGold in 1996, which came up, the dot-com bubble started to get legs underneath it.
You had PayPal.
Well, yeah, PayPal. But you had eGold was like a literal digital currency that was essentially, I think, pegged to the value of gold, or backed by the value of gold. And of course, what eventually happened was that you had criminals utilizing it, because it was mostly anonymous, to conduct transactions. And eventually it was shut down because you had multiple people who hacked the platform and ruined it. Then you had Web Money in 1998, which was a Russian venture. So this came about right at the height of the Russian financial crisis, when the Russian mafia was essentially taking over large swaths of the economy. And it was this sort of peer-to-peer payment and merchant and billing solution that was very anonymized, very secure. But it kind of crashed and burned, and it's not really used much anymore, although it's still around to this day in Moscow. And then there was a big gap from what the timelines I've seen. And then you had in 2006 Liberty Reserve, which was almost like a beta test for Bitcoin. So it had like a centralized anonymous money transfer business. You could create a platform, you could create an account on the platform, and you could transfer money to anyone without any verification, but again, crash and burned. And there was this big swath of time where no one was really taking this stuff seriously until 2009, when, as Hank was saying, Bitcoin sort of appeared out of nowhere. And there were no bugs, or there was one bug, and it was a very secure system. It was elegantly made with a high degree of mathematical expertise that most mathematicians don't even bother venturing into because of how difficult it is to make any headway, which is cryptography.
And it was embraced by the
there's
system.
also the just one more fun fact about Satoshi. So Satoshi was the first person to mine Bitcoin, obviously to bootstrap the network, and continued mining for a little bit. And he currently owns, according to the blockchain, you can look up, of course, how many Bitcoins are associated with his addresses. He owns about $1.5 billion worth of Bitcoin. And there are serious questions about, okay, so was this like I think each of us have done where, oh yeah, I really should have backed up that hard drive? Does he still have access to his keys? Is he a reclusive billionaire in some Tahitian island? Is there, like, in some dumpster somewhere, the lost treasure of Satoshi Nakamoto?
Well, let's go down
unclear.
this exercise
Very
for a second.
spooky.
So let's just say there's $1 billion pot waiting at the end of the rainbow, and you're like, okay, look, I'm not going to be able to guess my way through this using my brain, but what if I dumped enough computing power trying to decrypt his key? What would that entail?
I don't think that's technically feasible unless there's a major breakthrough in cryptography.
Like
you
computing,
might
you mean? Like,
well,
it's more of a computing problem, right?
Yeah, I don't remember off the top of my head which algorithm they use for the Bitcoin securing of the public key, and if it would be even amenable to quantum computing, because
might be SHA-256.
Yeah, I'm not sure if because there are quantum resistant hashing algorithms, there are quantum resistant public-private key setups. So I'm not sure. Like, if you had that amount of resources to burn, like, it would probably cost like over $1 billion worth of computing resources.
That's the sort of question. That's the question. Like, what would that cost?
Yeah, I mean, more than you would realize. Like, right. You would probably be better served if you really wanted that money, trying to hire an army of people to try to figure out who this guy was.
Yeah, right. That's interesting. So where does the future hold for money and Bitcoin, at least, for everybody? Do we all go out and buy Bitcoin, or do we keep our bank accounts, or do we go into gold? Like, what's the scenario here?
Well, there's a really nice book, Debt to 5,000 Year History, the first 5,000 years, something like that. I agree with the thesis that is, like, the sine qua non of money ends up being, like, I can pay taxes with this. Like, that kind of constructs the baseline demand for money when you have taxes that are, like, frickin' 30% of your economy now. So I can't pay my taxes with Bitcoin.
Right, but I've heard that they will tax your Bitcoin profits, though.
Oh yeah, sure.
But not in Bitcoin. They won't accept payment of Bitcoin. Yeah, surprise. But this is why, like, holding currency is usually a terrible investment, because it's not really invested. You're just speculating. So, I'm happy to use it as, like, a transaction medium if there's, like, some Russian dude I want to pay who only takes Bitcoin. But I'm not meaningfully long that currency.
Well, what I imagine, or what I could imagine, and I kind of hope this will happen, is that we'll have a sort of dual money system. So, like, for example, Hungary, they use the Hungarian forint as their sort of day-to-day currency. You pay your taxes with that. You pay many things with that. But you can also use the euro for a lot of transactions. You can do this in basically any of the non-euro countries in the EU. It's just sort of handy to have euros often, especially in the poorer ones, in the Visegrad countries, in the Balkans, maybe not so much in Scandinavia. But, that's a proven way to do business, to have two currencies in one country. And I think that, like, maybe over time, what we could end up doing is having a dual system, say in the US, where we do some transactions in Bitcoin, we do some in US dollars. And then when we need US dollars, if we're primarily Bitcoin, we just buy the dollars and sort of, move seamlessly between the two.
That's interesting. That kind of harkens back to the 19th century US, where you had competing currencies issued by varying financial institutions.
You also had the silver advocates for making a silver standard.
I mean, there are a litany of ways beyond barter to exchange currency, different kinds of currency issued by different people. I think going forward, if more cryptocurrencies take the Bitcoin model, such as Ethereum, and more continue to grow, I think that it won't totally matter if the supply of Bitcoins is limited, because I think at this point it set the bar for new currency in the United States.
The tricky part about Bitcoin, though, is that it, in a certain sense, like it's just like the gold standard in that there's no sort of exogenous way to modify the monetary base, the Bitcoin base, to offset these sort of shocks that the modern market economy is prone to. And as a result, like if a country did use Bitcoin, it would kind of be like in the situation where Hong Kong is in, or where, I don't know, Peru, or any country that uses the US dollar or uses a peg to the US dollar. And that would be that you can't control your monetary policy, and you're just at the mercy of whatever the value of your money happens to take on. If your economy needs, so to speak, or would benefit from an aggregate employment standpoint, a cheaper currency, well, tough luck, because you can't modify the value of the currency.
Well, some may argue that that's a feature, not a bug, and that the inflationary tendencies of a, let's say, economy that wants to export its way back to prosperity is not possible with Bitcoin. And so if you're a holder of Bitcoin, you have more confidence in it as a store of wealth rather than a means to get your people employed, which is a different use case, right? So, with the sort of volatility that happened in the financial crisis, I personally knew a lot of people who were advocating for Bitcoin because it was not based on a authority that was going to print money like the quantitative easing was doing, and that again is it's favoring the saver essentially, not necessarily the earner. Does that make sense?
Yeah, I mean, I could expand on what you've just said, or possibly had things to say, but maybe I'll just leave it be.
There's also the possibility that you could take certain aspects of the many different technologies that make up Bitcoin, and you could actually use them in a way that corresponds to kind of more fiat-friendly usage patterns. So, like, there's a lot of discussion on Wall Street currently about using various blockchain technologies as a way to track the ownership of actual things. So, for instance, government bonds. You could imagine something where, like, instead of Bitcoins, what you're actually doing is, like, you have a bond object that's, like, signed with the U.S. Treasury's master key, and then you track transactions in this bond through the exact same blockchain mechanisms with, like, mining fees and, like, a consensus ledger and what have you, in a way that would cost a lot less than current bond clearinghouses charge. And you could even do this with, like, literal, bonds are obviously kind of sort of basically money. So at this point, you have, like, a government that's able to issue things to increase the supply or to decrease the supply if you have, like, callable bonds or something. But you have, like, the same semantics around pseudonymity, around distributed consensus, like potentially low transaction fees, reliability, decentralization. You could also do a thing where, like, not literally anyone can mine Bitcoin. Like, you could progressively lock down the system where only people with certain approved private keys are like allowed to transact on the network, or like allowed to transact in certain ways, allowed to collect transaction fees, or to do whatever. So I think that we will eventually see aspects of these technologies filter down, at least in the technical level, to kind of the existing electronic payments and trading infrastructure that we were talking about in the first part of the show.
Well, when people talk about blockchain technology, it's not referring to Bitcoin. It's referring to the blockchain concept. And
right.
It just so
distributed
that,
consensus ledger.
Yeah, and it just so happens that Bitcoin is the most well-known, perhaps most used blockchain. But there are many competing blockchains out there. We mentioned Ethereum. There are a lot of tech companies who are actually trying to figure out what to offer the banking system so that the banks don't feel scared of the threat of Bitcoin. And so there's lots of different competing technologies using blockchains that go by different names that the banks are looking at. There's many applications for this. It's basically just, like you said, it's a distributed consensus ledger.
So what would blockchain actually end up doing to the financial and banking system? Would it sort of centralize it even more so?
It would be the opposite.
So. Yeah.
Like, I mean, well, it depends on how it's implemented. Like, if you have some sort of weird system where there's only a few people who are allowed to attempt to achieve consensus, then it centralizes it to those nodes. But what you'd be talking about is taking something like a bond clearinghouse and basically just getting rid of it. And having, instead of one clearinghouse that maintains the record of who owned which bonds and which date, that would exist as distributed knowledge through the member banks of whatever system that you were setting up. So it would presume
a mass transition though is going to require deflation. Potentially quite a bit of deflation indefinitely. Basically, we don't have
not necessarily because, with Bitcoin, sure, if you were just relying on Bitcoin, but for other things, you could just take the Bitcoin software, have a different origin block. So now you're kind of in a different world, and set it so that you have this one magic key that can mine a block of Bitcoins at will. And we call that the Fed key. So the Fed can arbitrarily increase the number of Bitcoins, and I guess they can't destroy them per se, but they can use the same mechanisms to claim them for their own account and then just not sell them and consider them as destroyed.
I would call that the print key, if you remember your old IBM keyboards.
Yeah. Oh my god. And then of course you have to guard those keys, and if those are ever stolen, then you have to fork the network, and it would be a big disaster. But these are things that are not technically incompatible with a modern style monetary system.
Okay, that makes sense.
And then you can get very dystopian with it, where if you have all of these sort of moves like they're making in Europe, where they're attempting to crack down on the use of cash. The United States, a $100 bill is worth half of what it was in 1975, and it's not like they're ever going to issue a higher denomination. There seems to be a trend in actual policy towards making transactions more trackable. So, the dystopian vision is, you get your government issued private key that is your Bitcoin wallet. And you transact with that because keys that are signed by the feds are the only keys that are legal to transact with. Mm-hmm. And as a result, all transactions end up being recorded in this ledger through the magic of capitalist incentives to collect the transaction fees. It's a very neoliberal, techno-dystopic vision of payments.
wouldn't that be just wonderfully ironic if like all these, libertarian anarchist type people who were promoting Bitcoin were actually like, promoting the field testing of whoever, designed this thing, some nefarious agency of the, the system where we moved to like the universal futuristic credit, the omnipresent credit currency in sci-fi.
Well, it's like the history of Linux, essentially, where I think Linux now is used heavily by the U.S. government, by the U.S. intelligence services, by a litany of groups that I think the early Linux community were trying to avoid by developing out Linux in the 90s.
I mean, it's a technology. It's going to be used by whoever can obtain it. So I don't know if it's ever preventable. Yeah, I don't know. Where do we go? I mean, it's just like any other point in history. You got to do your best and don't put all your eggs in one basket. I would never advise that. So I think it's a good competing technology. I think competition, not to wear my libertarian hat too hard, but I think it's a good thing to have Bitcoin and the US dollar and the euro. I think those are good. I would hate it if everything became one or the other, because then you have, again, it's a centralization problem. So I'm
and the one major downside of Bitcoin is that like it's impossible to spend without having access to the network. So like
yes, you need a computer, you need a network. Yeah, that's right.
And you need
the
like
network,
connection to like the network, because you need access to the majority of mining power for there to be consensus.
Well, the biggest machine in the world is actually the U.S. power grid, and because it's all integrated together. And so if you pulled the plug on that, yeah, there's a lot of miners in China, but yeah, like you're screwed.
even like snipping a couple of underseas cables. So a heck of a lot of Bitcoin transaction volume is devoted to people in China trying to get their money out. Like most of the big miners, from what I understand, are Chinese running dedicated Bitcoin mining hardware with subsidized electricity of one form or another, for sort of unclear / illicit purposes. And it would be fairly easy for the Chinese government to just kind of cut them off one day, which, the network would still function because it's, the majority of the mining power that you sort of have visible to you is where you see your transactions come up. But you could have a situation where, like, much like the Chinese kind of fissioned their internal internet, you could see a forked or partially forked currency where you had like, Chinese, I'm just using them as an example, it could be anyone, but like Chinese transactions end up happening on their own path, and non-Chinese transactions end up happening elsewhere, which would really screw with things, because that seems to be also where a lot of the sort of economic value of Bitcoin in like various forms of illicit money transmitting comes from. So if you crack down on that, then like your Bitcoins lose practical value.
And I imagine that would make international trade and financing international trade much more difficult in the long run.
Yeah, I mean, if you can like arbitrarily cut off your citizens' access, like in Venezuela, they have literally a dude in a truck, things might be a little bit too far gone now for this to happen, but at one point, you had a dude with a truck loading up Venezuelan bolivars or whatever they have, driving it into like the back end of Brazil, like swapping it for dollars and driving it back, because this was the only way that you could evade the currency exchange limits. This is essentially impossible if like the entire point of the network is to like make this transaction visible and memorialize it for all time. So, I mean, the system, honestly, I find it extremely interesting from a technical perspective. It solves like a couple of hardcore computer science research problems around distributed consensus. It's a beautiful project, but don't really know that it is a sort of a cash substitute. Like it strikes me as kind of antithetical to a lot of the things that I desire in a actual currency as such.
I agree. I don't want to see it replace cash. I think it's a welcome counterpart in that it has a hands off, don't tread on me aspect to it that no government has any influence over. But I would not be getting rid of my hard currency at the same time. So I think it's a nice countermeasure. It's a nice alternative. But again, don't put the majority of your holdings in it.
And frankly, it's not even beyond government control. So there's
no, it's not. But nothing is if you make that argument. I mean, it's all relative.
It's even like more, even in its current form, without changing the protocol. So there's a State Department list of prohibited persons and organizations that, like, basically no American is allowed to deal with these things. So this is like you had a few like ISIS bookstores, like the name of the bookstore is like ISIS Books or something, and they basically got cut off from like all financial transactions because the bank was like, oh, well, we can't transact with anyone who has the string ISIS in their name. Kind of dumb, but
right.
But it would be equally easy for them to be like, okay, so this like entire address block, we've identified all of these addresses as being affiliated with these people we don't like. So no American, no financial institution, etc., is allowed to transact with like these particular Bitcoin wallets.
There are ways around that pretty easily.
Well,
actually.
I mean, sure, but it significantly increases the risk and the overhead involved if like suddenly Coinbase won't let you transmit to these people, so you have to like use the protocol software directly. And like if it's ever traced back to you,
mm-hmm.
which again, like Ledger, it lives forever. All they have to do is associate the wallet with you 30 years from now, and like they can look back through that entire history. So I mean, even in its current form,
your point's taken, but it's not
impossible.
I mean, you basically just create a new key, and you do that with various masking, VPN tunnels, whatever you want to do, but just make sure that the I don't need to go into it, but there are many ways to get around this.
Buy Bitcoin face to face.
Oh yeah, of course, but
from a shady dude in the marina.
But the key is what you're worried about. You don't want that key connected to you. So once you have the key, you do it however you can do it, and that would be the way to do it. But anyway, Hans, go ahead.
Well, to Adam's point, just in the same vein that you shouldn't be totally bearish on cash just because there's a rise in Bitcoin, the same point goes to being bearish on precious metals or any sort of classic means of exchanging value. And I've seen this trend a little bit where people are talking about, well, Bitcoin is ultimately going to overcome precious metals and value, and essentially it's an electronics problem. At the end of the day, if you're cut off from the decentralized mining network, or if there's a lack of electricity in general, you can carry your hard drive around with you with your Bitcoin wallet, sure, but it's not going to mean much.
Well, it's not so much that your wallet is not accessible. It's the network.
Just inherently useful. I mean, as long as Hindus plan on having weddings, there's going to be a massive demand for gold, and of course, it has many manufacturing applications.
Right. Warlords like chains. This has been true for like 10,000 years. Like, if there's a big dude who's like in charge of employing violence in order to maintain his position, he's probably wearing a gold chain. So like you have something to offer him.
Well, what do they say? It's beans, bullets, and Band-Aids in a crisis.
Yeah. I've heard water and weapons.
Yeah.
Hey.
Yeah, I mean, it's like, for me, this is all just kind of a portfolio thing. I'm not in the game of speculating. Some people are, and some people are good at it. I find that I'd rather put my energy on things that I can control, and things that I can't control, like, what the markets are doing, I'm going to have a portfolio. And so I would recommend people have a little bit of a lot of things, and then, have a concentration in things that seem more secure than others, but never count on one thing. It's just too uncertain of a world that we live in.